So if you want to raise funds for your business, these are the steps you must put in place in order to ensure that you don't turn the time you spend doing it into wasted energy. Hello, welcome back to this week's podcast. And this week we're going to talk about a subject that may or may not be relevant for you as a particular salesperson if you're in this listening to sales and selling. But it's a subject that's really, really interesting, topical, and people love to have insights on. And even if it's not suitable for you, then it's a story, some stuff you can share with people that you will hear that want to run a business or have a business. And that's what's involved in raising money, funds for your business. So raising investment for your business. And this is something I've wanted to cover for a little while because I get asked questions around people raising money for funding. I've put money into my own businesses myself, and I've made some good and some bad decisions on that basis. But I also got asked, what do investors look for when it comes to raising funds? To raising money for businesses. And I want to share with you some key points you're going to need to put in place. And even if this isn't suitable for you, listen in, because it will be suitable for someone that you know. There'll be a friend, a family member that's saying, "Oh, I want to raise some funds, or I'd like to raise some investment for my company. Can you help me do this?" And so you can be the person that says, "Hey, I listened to a podcast the other day and share the insights with them." So like I mentioned, back in 2013, I raised £475,000. I actually raised a further £120,000 about a year and a half later. But I raised that money for the business that I owned at the time for a shareholding in my company. And I actually had raised some money initially back in when I started it, but of 20,000. So I've raised sort of money 3 times. And I know what's involved in raising funds for your business. And it's, yes, I'm a good salesperson, so I've been able to convince people 3 times. But there's also, especially the second time where we raised the majority of the money, there was a number of things that we had to go through for that I encourage people to think about and to put together. And so, yeah, bear in mind that this is the podcast for you if you are also in that position and you're thinking of raising money and putting money in place. So to give you a scenario, I'd raised when I raised my money, I had a business that had been going for 8 years already. So we'd been going for quite some time. I'd bootstrapped it is the term that's used. So I basically built the business up from nothing and raised it. So we were doing just under £30,000 a month of recurring revenue. So just under £360,000 a year of recurring revenue per month when we raised our funds. And the process to raise the funds was really interesting. The first thing that I encourage people to do when they're raising funds is to see, if you want to raise money, is to see if you can become EIS or Seed EIS registered. What does that mean? Is we raised the money the money that we raised at our stage was from angel investors. And you'll get different types of investors. You'll get friends and family that will raise money initially with you or give money initially with you. You have your own money that you'll use, or you'll then have called angel investors or investor networks. You can also use crowdfunding. Crowdfunding is another route nowadays. But you're not going to get venture capitalists involved in raising money at the early stages of the business. They're not going to be involved at that stage. It's too small for most of them, unless you've got a technology that's so unique and so different. The reality is they're probably not going to get involved and raise money that way. So you're going to get what I call angel investors. And those are generally people, I've got a number of friends like that they're relatively wealthy people. They've got some spare capital. And what they do is they invest the money that they put in and they offset it against their tax. So they might get a tax bill every year. And what EIS does is it enables them to offset. So let's say they put in £50,000 or £100,000 into a business. They can offset a third of that. So £33,000 of that they can claim off their tax bill by putting money in. So by becoming EIS registered, and you'll need to get your accountant to do this, it can enable you to basically say to your investors, hey, you're invested £100,000, for example, but you're only investing 67 because a third of that you get back in tax relief. And people like that, investors like that. And they also like it even more because there is a final stage to that, whereas if the business doesn't even succeed, they have the option for a further third to be reclaimed off their tax in basically if the business isn't successful. So the net effect is, even though that person might be putting in £100,000, even if it doesn't work out, if you're EIS qualified, then the worst case scenario for them is £33,000, which, all right, still a lot of money, but it's not as much as 100,000. So firstly, try and become EIS registered. It might cost you a few £1,000s to get that set up with your accountant, but it will certainly make people more inclined to look at you. And those people that are angel investors are going to find that's quite an attractive element to them. So point number 2 around raising money is accept that it will take some time. So when I was raising my money, I remember thinking we started the process. I think it was like January, February in 2013. It might have been the previous November. And I remember we didn't sign the deal until, I remember it was the day after my wedding anniversary. So it was September the 20th, 2013. So it took nearly 6 to 9 months to get everything put in place. And I talk to business owners that say to me, I want to raise some funds and get some money in place. And they're like, oh, okay, cool. What do you want to raise that for? Oh, for 3 months' time. I'm like, good luck. Just to get everything done and dealt with in a proper way is just very difficult to do in that short space of time. It does take time to get things in place if it's done properly. And by the way, what I mean by done properly is if it's done with a proper shareholders agreement, with proper legals in place, with proper protection for the shareholder, for the person coming in, and protections in place for you. It's going to take some time for you to meet people, to have conversations, for them to then do some due diligence on you to check what you're saying is true. It takes time. So, I think it's a minimum 6 months, if not longer. So if you want to raise money for your business for 2025, we're now doing this at the end of 2024, being realistic, you may not get the funds until the middle of 2024. So if your business is reliant on funds like this to survive, then you may not get there, is the honest answer. And that's something we'll pick up in a moment, but just accept that it takes time to look at this. Which sort of leads me on to my point number 2. And by the way, these aren't in lots of order. This isn't in a priority order, but these are just things to consider. The best time to raise funds is when you don't need them. So what do I mean by that? If you are in a position as a business where you are, you've taken on extra costs, you're invested in certain areas, and that money hasn't come through, and you're making a loss per month, then people sometimes say to me, oh, well, I need to raise some money because, we'll run out of cash. The moment you start to do that is you're putting yourself in a very tricky and dangerous position with your investor, and you're becoming a business in distress. And being honest, investors generally don't like to invest in businesses in distress because they don't want their money to go down the pan. More importantly, even if you do get them to invest, they're going to literally want much more of the equity than you're prepared necessarily to give away. So the first point is, the second point is raise money when you least need it. Okay. So if you've got, you're cash rich and you do really well, but you want to invest and build something and you want to grow, then start that process of raising cash then, because it puts you in a better position. People might even ask the question, why do you need to raise cash if you've already got existing funds in place? And that's then you can explain the story and the vision and the plans that you have, which will hopefully excite the investor to want to work with you. So raise it when you don't need to raise it is where I'd start. And I say, and also to follow on from that point, raise more than you need. People always say to me, you should raise double what you say. I wish I'd raised 10 times the amount I raised. It would have been a lot easier for us to try and compete in the marketplace. Bear in mind, we were in online software, so SaaS-based software in 2013. Now, 11 years ago, trust me, when I started, we were not, SaaS software wasn't, the cloud software, I should say, wasn't as available as it is right now to everyone. So we were in a marketplace that was growing, but we needed more money to be able to do what we wanted to do. And it would have been far easier to ask for more money than it would have been. And if we'd have asked for more, we may have got rejected, but would have been the process and the time it takes you to raise money. I always encourage people to raise more than you can. So if you need 250,000, try and raise 500,000. If you need 500,000, try and raise 1 million. Try and double what you need. It's worthwhile. You might have to give a little bit more away in equity than you want, or you can do a bargain your investors down. But you're in a far better position to do that than to raise money and then go through the process of trying to do what you say you will with the funds and then have to go back and raise more. It just takes more and more time on a regular basis, and you want to avoid that if you can. So that's point number 2. Raise more than you need to, and raise it at the time when you don't need it, and you're going to be in a better place. But next point is this. Show to your investors that you've got some money yourself in this. When I raise money, I was able to show my investors that I not only just put money in, but one of my biggest mistakes is I'd taken on a huge amount of personal debt by not taking a salary properly for my business. And even though, some looked at it and thought that wasn't ideal because they wanted to see real costs on the books, they also saw that I was totally committed to it. So my question to you is this: if you've not committed some sort of money yourself or commitment yourself, if you've not got some skin in the game, then it's going to put other investors off you. So I'm not saying you should go and remortgage your house tomorrow and do all these sort of things. Be very careful about doing that sort of stuff when you're trying to raise money. But investors are going to want to see that you've put your hand in your pocket, that you back your own idea. And mainly it's about not just the money side of things, it's because they want to see that you back your own judgment and you back your own skills and you're good enough to do what you say you will do. And that it means something to you. And when you've got skin in the game, you generally do work harder because you don't want to lose out on with the money that you put in yourself. So show that you put something in yourself, not just in time. People say to me, I've put time into it. Well, time is that everyone can put time into it. So what have you had to do? I had to, and when again, in my business, I've explained in a previous podcast, I had to move out of my house. I had to move in with my parents. I put my own money in to start the business off. I invested. I took a huge amount of money. The company owed me a huge amount. I even did a lot of consultancy for a period of number of years in order to fund the business. So I put a huge amount of money in myself, and people like to see that because it shows that you're committed. Okay, next point is this: accept that you're going to meet lots of people, and accept that you're going to have conversations with different type of people, and some people it's not going to work for, and don't take it personally. People say to me when you're raising money, they take it personally just because someone didn't want to invest in their company, and don't be like that. There are some investors, and I now know this in my world now, and I've made some bad investments, especially in the last few years. Actually, I wish I'd not gone down those paths. But when I look at it and think what I've done, I strayed away from what I was good at. I'm really good in the sales, business development environment. That's my space. I've invested in a business now which is proven valuable. My growth resourcing business, my outsourced telesales business or calling business in South Africa. But it's an area I know well, sales and selling. I've invested in clothing businesses. I've invested in construction businesses. In terms of my time, I've invested in networking businesses. It's not my space. It's not what I know. And I really encourage you to focus on what you know. And good investors will spend time in the areas that they're good at and they know. I've got a very good friend of mine who invests in companies. He tends to invest in software companies. That's what he's good at. That's what he knows. That's what he's built his career in. So that's where he spends his time. He may get offered the chance to invest in, he has been offered the chance to invest in other organizations, and he's gone and said, look, it's just not my area. So just accept that you're going to have to kiss a lot of frogs to get the prince. But always remember to kiss the frogs with gusto. And the reason being because, that frog may not be the prince, but they will know people that are princes. So again, go back to the people that I spoke to initially. I had conversations with people that didn't turn out into anything. That wasn't for them. But they were able to say, this isn't for me, but I've got a friend, a colleague, associate, someone I did business with, another investor I know who does like this area. Let me put you in contact with them. So when you start to have conversations with people, much like sales and selling, you can start to discuss what's going on with other people. It makes a big difference. You can open up other doors, you can connect with other people, and that can give you the opportunity to really meet new people, even though the person you're selling to might not be right for you. So accept you're going to have to meet lots of people, and that's why it takes time. There are some people that can go on 2 or 3 week tours to meet people and do meetings every day. That in itself is great, but who's managing the business while you're doing that? There's a consequence for that. So look, there are, and that's why most people tend to do it here and there every time. But you're going to need to, I think when I raised my funds, I must have had 40 different meetings in order to meet the 7 or 8 investors that we raised money from. So just bear in mind that it's going to take time to do that. My next point is this: have a plan that's bold but achievable. So when I raised money again of what we wanted to achieve, we basically had a really bold plan and vision of what we wanted to get to, where we wanted to get to. But being honest, the plans that I put forward, one of the things that cost me in the end, for me, was that the plans I put forward weren't achievable. And, I would have been better off to go with some lower plans that I could have achieved. And I'd have been better to underpromise and over-deliver than overpromise and under-deliver. And the reality is people think, people, I want to share a vision and share a story that's exciting and big numbers excite people. seasoned investors will always look at your numbers and then take 2/3 off those numbers and then see if the business case stacks up or if the marketplace is interesting to them. Just because you produce a spreadsheet that says you're going to sell 100,000 units or items, don't think that someone's going to go, oh, amazing, that must happen. They will take off those numbers anyway. So try and be bold, but try and be achievable, because when you come up with plans that are so fanciful that people go, I don't believe it, it puts everything else into doubt, into question. So, be able to put some plans that are achievable, but also back up where you've got that data from. It's not just, finger in the air, I think I'm going to get this number because, my market size is X. Do some work to show how that figure is reasonable and achievable, and what you're going to do to try and take advantage of that. Because that's going to be what an investor's looking for. They're looking for the reality of things, not just what you say. Because we all think our businesses are great and are amazing, but in reality, we're asking someone to put their hard-earned money into something they don't know about, and that's going to make them be a bit skeptical. So you giving them a fanciful vision that's just full of complete and utter fancy land is not going to probably warm them to you, and it's going to make them think that you're not in down with reality, and probably make them count that against you rather than for you. So be bold, but make it achievable, and be in a position where you also can share a story. One of the other things that I talk about is about the story that you need to put in place. In my case, when I raised the money, I talked about how cloud software was going to grow. I talked around how the marketplace was going to change. And by the way, if you'd like a copy of the deck or the presentation that I used, reach out to me. Drop me a note on, put it in the comment section below, and reach out to me, and I will send you a copy of the slide deck that I did that raised the money, because I was able to share a story around where the marketplace was going, and my marketplace definitely went there because, and I wish I could say I benefited totally from it, but I didn't. But, cloud software has grown and grown and grown, and the companies that give an example, when I started my business, HubSpot didn't even exist. And HubSpot's one of the tools that people use now. ActiveCampaign, I think, might have existed, but not too massively. So I made lots of mistakes in my business, but we were in the right area, and we were able to sell a bold vision, and people want to see that. And that part of that is also being realistic about, another key point here is to be realistic about the downsides as well as the upsides. There's a great book by Marcus Sheridan called They Ask You Answer, where he talks about things that are going on in the mind of your buyer. And investors have downsides in their head. They have some things that they're thinking, will it do this? Or what's that market going to do this? Is there a competitive issue here or whatever? So be prepared to at least answer those questions. Be prepared to look at the downsides. Be prepared to at least have those conversations with people rather than being deluded and think they won't be thinking that. I remember one of my investors saying to me, and also don't be a dickhead with your responses. One of the people that I talked to, he said to me, oh, your market space seems to be quite competitive. And me being a glib, what was I at the time? Can't remember what age I was, 2013, 11. I was like, mid-30s-year-old software geek, software dude, I should say. I remember saying, oh, your market's quite quite competitive. And I glibly said, oh, yeah, well, $4 billion markets tend to be. And I looked like a dick, and he basically didn't like the way I've approached it. So, don't accept there's some downsides. I should have said, yes, there is some competition in the space, but this is a huge market space that's got, worth billions of dollars, and this is why we think we can build our sweet spot within it. Understand that there are going to be some concerns that people have got, and try and address those. Even if you don't need to bring those up initially, have them in your locker so that when, someone does ask you about that, you're prepared. Again, so much in sales and business is about, and in raising money is about being prepared for the eventualities. A great advice that I give to people is get a notebook, write on the middle of it investment, and write down what the things that would worry you, or if you're an investor investing in your company. Write down all those questions and then try and create yourself a Q&A or some videos or some materials to support and answer those questions. And if you can do that, then it's going to help people see that, again, you're living in the reality and in the right place. And I guess one of my final 2 points really related to investment is have a track record of achieving success, but also have a team in place to achieve success. So for me, when we raised the money that we did, we were able to show that over the period of the last number of years, even though the growth in some cases had been smaller in yet some years than others, we'd grown year on year, and we'd grown on numbers of the business, and we'd grown our user base. And people were able to see that there was a trajectory of growth. And that was really important, because what people are buying into is they're buying into you delivering, they're buying into you investing their money into you growing and to continue to hit numbers. And what they're going to want to see is details of where that growth has happened. Past success leaves future clues. And that's what people are going to want to see. That is, if you've had a track record that's up and down like a milkman's handbrake, the reality is don't be surprised that your investors then think, not so sure this will happen. Whereas if you can show growth over a period of time in what you've done, then it's going to give the investors confidence. And as I mentioned then, the track record also involves the team of people. Invariably, they're going to invest not just in you, and their big worry will be, what happens if you're not there? So they're going to want to see the team of people that you've got in place. Have you been able to build a leadership team, a management team that is full of people that are experienced and knowledgeable, or have got commitment to working with the company? Because if you're not there, they want to know that they can de-risk their investment and other people be involved. And that's something, again, that's I think is hugely important when it comes to raising money, is to make sure that you've got a team in place that have got a track record of achieving success and can show that track record of success. So look, those are some of my thoughts on what it took me to raise money for my own business. I hope it's been helpful for you and useful for you. Raising money is intriguing and interesting. It's one of the best things that you can do. It's an incredible experience. I did as I say, I've learned a lot of stuff around it. I learned a huge amount of positive things and negative things that I got wrong. And I encourage people to try and move forward and do this if you want to grow your business. Some people say, no, I don't want to take on an investment. I don't want to dilute my shareholding. That's cool. I always used to think I wanted to own 50% of a £10 million pie rather than own 75% of a £1 million pie. The reality is that's how I saw it. And I encourage you as a business owner, if you think there's a huge opportunity in your market and you think that there is, you're in a high growth area and maybe you haven't got the cash yourself directly to benefit from that, you're better off to bring other people in with expertise and also knowledge. I brought investors in that had knowledge and expertise and who can help you, and they will become a cheerleader for you than necessarily keep it all to yourself and then miss out on the opportunity. So really keep it in mind. And maybe you're listening to this and thinking, I haven't got a business idea. I haven't got a business myself at the moment, but I had an idea for a business. And this can give you some background as to what you need to do to put that in place. But look, raising investment and raising funds isn't easy, but it's very rewarding when you do it. And, we all see shows like Dragon's Den and those sort of things that show how people can raise money. There's always that difference around valuations and how you should value your business. I'm not going to cover that totally today. Ultimately, it depends on where your business is and the industry you're in and what you've achieved. But the reason I also am talking about it today is fundamentally, if you are in business doing that and trying to raise money, have a sales engine. One of the things that was critical for me when I raised money was I was able to show that I could achieve sales success. And even though I didn't get many things right as a business owner, achieving sales and bringing sales in consistently was one thing I was good at. And investors certainly want to see the tills continue to ring and the business growing. And that's something you need to bear in mind. So, look, what I'm going to do, as I always do, is finish the podcast off with, I hope that's been helpful for you, by the way. If it is, let me know. If you're raising money, let me know. I'm happy to share some ideas to help. Happy to even, if you want to provide some support to you, then reach out and I'll talk about that. But it's worth getting the right advice in initially to make it happen. But as I always do, I finish the podcast off on a positive, inspirational story. And I wanted today to talk a little bit about a guy called Chris Copeland, who is an 81-year-old man. And Chris was set himself a challenge over a decade ago as an 81-year-old man to raise over £100,000 for the RNLI. And he wanted to do that by completing 100 free-fall skydives. So basically, in a plane, free falling, and to raise he wanted to raise over £100,000 for the RNLI and to do 100 of these. And I think about skydives. I've never done one. It's actually on my bucket list to do. Actually, of doing a skydive. I'll make sure I invest in the parachute as well, by the way, for that. But or the right instructor. But I thought to myself, Chris is 81, so he must have had this idea when he was 71 to jump out of a plane 100 times to raise money for the RNLI. I thought, what an inspirational cause, and a great evidence that even though we think sometimes we're too old to do things, Chris at 81 or even at 71 decided he was going to make an impact on the world and did. And I think that sort of story is just incredibly inspiring and helps us all understand that we can always achieve anything we want to if we put our mind to it. So Chris, thank you so much for being an inspiration to us on the podcast this week. That's your story, and I hope Chris's story has given you some inspiration to do what you want to do in the next couple of weeks and months ahead. Maybe that's to start a business and raise some funds. Maybe it's to go back to the market and raise funds for your existing business. But whatever it is, I hope the podcast this week's been useful. As ever, please let me know your thoughts. Tell me what you think. If you like it, let me know. If you don't like it, let me know. I always say to people, I've got a skin like a rhino's backside being in sales for a long time, so you won't offend me. I'd rather you tell me what I'm doing or not doing isn't working for you, if that's the case. But if you are enjoying the podcast, please share it with others, tell people about it, give us a rating and review. That would be so helpful so we can continue to help more people, support people to get the results they want. But that's this week's podcast on raising money for your business. Hope you've enjoyed. If you have, I'll see you next week. And thanks as ever for your ears. Take care. See you soon.